My name is Randy Tate, and I am obviously the CEO, not the CTO or no technology or anything of that of this company. And I'm one of the founders, and I'm going to be here tonight to take you through this awesome webinar to talk all about flipping Wall Street. So that said, I'm going to put the technical difficulties behind me, and I'm going to move ahead as if nothing happened. All right, so here we go. Hope you guys are ready. Welcome to our webinar this evening, everybody. My name is Randy Tate. I am one of the founders of Flipping Wall Street, and I'm going to be here this evening to talk to you a little bit about our company, who we are, what we stand for, why we did it. I'm also going to introduce you to my partner, Kelly Korshak, if he managed to stick it out and stay on the call long enough to be part of it. I'll be unmuting him if he comes back on. He's not here with us at the moment, but if he comes back, I will be sure to unmute him. And as we go through this call tonight, since there are only a few of you left on it, I'm going to go ahead and open it up maybe at the end for some questions or give you guys an opportunity to set up a call with me to give you a more in-depth demo and overview of everything we're working on. So that said, let's get started. I like to start out my webinars and many of my trainings with a simple game. And I call this game Myth or Real. And obviously we're here talking about finance. We're talking about the market and how it works and what's going on in that world. And so I'm going to put up some things that may or may not be myths, but they're things you've heard of. You've heard of these things I'm going to show you, and we'll make it easy at first. So when I put the information up on the screen, I want you to just say out loud, even if you're sitting in the room by yourself, is this a myth or is it real? Number one, Santa Claus, myth or real? Number two, diversification is a great way to manage risk and beat the market. Myth or real? You're probably on this one going, well, the first one was a myth, Santa Claus. Unless there's any kids out there, then it was real. And you're probably thinking this would be real. Well, many of you have heard this before, and we've talked about this, and your advisors have told us this, and modern portfolio theory even says this. But that, folks, in fact, is a myth. That is a myth. Diversification is a great way to match the market, not beat the market. And it might be an okay way to manage risk, but the better way to manage risk and the great way to manage risk is with math and algorithms. Now, next one of my favorites, myth or real? There's a leprechaun with gold and beer at the end of every rainbow. Well, if that was the case, we'd all be chasing rainbows and instead of being on this webinar. It is impossible to time the market. Impossible to time the market. Now, that to many of us is a fact. We've been told this. We've had advisors and professionals tell us that it's impossible to time the market. Well, that's not true either. It is possible to time the market. So that also is a myth. So all four of those were myths. So Flipping Wall Street, we're here to dispel some myths, and I'm going to dispel a bunch of them tonight. And like I said, if I get Kelly back on the line, I'm going to unmute him and let him come on and chat with us a little bit, because Kelly is the brain child behind the actual software. He's the guru behind the algorithms. Kelly is a world-class hedge fund manager. He's the guy that got degrees from the University of Stanford by the age of 19. I should put that in his little bio there. And ran risk management for a little organization called Deutsche Bank, one of the largest banks in the world. He's managed billions of dollars at a time. He's led MIT math graduates, and he is quite frankly a genius, I refer to him as Michael Jordan of the hedge fund world. And so that's Kelly. Many of you know me. I've talked to you guys. I saw a lot of you folks this last weekend at the City Summit, and appreciate all you guys being there. That was an absolute wonderful event. I would encourage anybody that's on this call that's never been to a City Summit event to attend one of those. It was a fantastic event. And what we do together is we have taken mainstream finance and the way the Silicon Valley functions, and we've squished them together. We're kind of like some mad scientists doing things that don't normally go together. And in doing so, we have no doubt, it's no longer about what we're thinking is going to happen or what we want to happen. We are in the process of changing an industry around finance. And we're doing that for several reasons. We have some problems. And if you'll indulge me for a minute, I'm going to talk for a few minutes about some of these problems. As I've been around the country, the world, actually, the last year, I've been talking to a lot of people. And I've been asking this question a lot. And I find some redundant answers that happen over and over again. And they all fall into some categories. These are all real answers. Somebody told me their retirement's coming from a shoebox. They were afraid or scared to put money in an institution, no banks, no investments, no real estate, their shoebox. That's where their money went. I've had people think the dinar or the dong, foreign currencies are going to do it. People are going to get in a lawsuit. It's in their mattress. They're going to win the lotto. Now, when we think about those things, it gets really interesting to see what that leads us to. Because we've been operating from this perspective for a while, especially in first world countries. And what that's led us to, let's do some math. Kelly likes to do math, and he just texted me that he's not coming on, but I'll introduce him to you guys at a later date. But he always says, do the math. So let's do the math. At age 65, the average retirement savings, $104,000. So the average retiree at 65 has $100,000. How long can you live on that? Probably not very. And 29% have zero. Now, if this is not you, this very likely is somebody you know. And if you know people that have moved from their 60s to their 70s, their 70s to their 80s, their 80s to their 90s, and you've seen what that life looks like, imagine what that life's going to look like in the future without any money. And that is where we're headed. And it's really important, and it is very deeply rooted in me and my mission to fix this problem. And here's the biggest piece of math of all. If you want to be retired for 20 years and you only want $5,000 a month, you need $1.2 million in that shoebox, folks. What's your plan to get your 1.2? I'm going to talk about that, and I'm going to talk about it very openly, but it's important that you get this, because we know if you reach 65, most of us are going to make it another 20. So what are we doing to get to that 1.2? Now, the other piece about this is that we have entrepreneurs all over the place in this country, and entrepreneurs are what makes it great. But entrepreneurs live for now. They work for now, and they don't pay too much attention to later until it's later. And that causes a problem that you're looking at right now. The other problem is sometimes we're like, okay, I'm going to go with an advisor and I'm just going to give somebody money every month. Well, that's one way to do it. But we live in a world of bullies. And I'm not saying, if you happen to be a financial advisor and you're on here, I'm not saying financial advisors are bullies. Don't misunderstand what I'm saying. What I'm saying is we've created a society where we can't even tell who the bullies are. Now, this guy we know, well, at least some of us know, Nelson Muntz from The Simpsons, the self-proclaimed bully. He's the guy that gives you wedgies, takes your lunch money, and just does it every day. That's what he does, no bones. But they don't all look like Nelson Muntz. Many of them look like our friends. They are trying to help us, and I do believe that they are, at least most of them. Their intention is to put us into the position that can generate us the most money. The problem is we've been doing it this way so long, we don't even realize how wrong it is, the way it's structured. The fee structures themselves are just off the charts. Now, I'm going to make a correlation here. Do you remember these? $10 for 100 minutes, $80 for 2,000 minutes. These are cell phone plans. Do you remember the time when you paid for your cell phone by the minute? Many of us do. Many of us on this call do. I do. And I remember that I frequently went over and how many of you held a stopwatch to make sure you were getting the right amount of minutes? And it's an inefficient way for the consumer to pay for their cell phone service. So somebody came along and said, hey, I'm just going to charge you $50 a month, talk as much as you want. And because of that, how many of you pay for your cell phone by the minute today? Probably none of you. And more importantly, how many of you would, even if it was available? Probably none of you. And so when we talk about change, we talk about the way in which we go about the problem, not just talking about the problem. Here's the pain point. The compounding of fees on the average portfolio, if you only are at a combined 2%, in 10 years, you're going to have spent more in fees than you had invested. If that doesn't make your stomach get a little upset, then I don't know what does. Which, over the average 20-year lifetime, could cost you as much as 50%. That's a big deal. And you have to understand that it's an efficiency mechanism that caused us to create this company. Because first came mutual funds. Mutual funds came along because we all wanted an actively managed portfolio. And we didn't want to be on the phone, calling our broker saying, hey, buy this, hey, sell that. Not only did we not want to do it, right? We didn't want to have to call, but we wanted somebody to do it. So we developed mutual funds. Mutual funds came around to build a diversified, there's the word, portfolio of a lot of stocks in a specific segment that would allow you to have a manager, a fund manager, run that account. Well, and then the fund itself takes its fees. And so you see what happens is if you're going to pay the fund and then you're going to pay the fund manager and you're going to pay them every time, no matter what, all the time, and then you're going to pay all the extra fees that come with it, it becomes very inexpensive for a very small gain. And since we're not a society any longer that sits for 30 years in one job, one pension type of position, it doesn't become very attractive. So billions, if not trillions actually, of dollars have shifted from mutual funds to ETFs. ETFs are much cheaper than a mutual fund. ETFs, though, are not actively managed. They're managed by a single strategy and a robot to just plunk them together, put everybody in a bucket. Let's get the whole herd, throw us all in one bucket with the same group of stocks and the same strategies and let it ride. And let the computer do the work. That way we can do it very cheap. An improvement, maybe, you lose the active management, but you reduce the fees. Now we have Flipping Wall Street. Flipping Wall Street takes the best of both and sprinkles on some new things as well. When we talk about Flipping Wall Street, we are an actively managed portfolio. We will actively manage it. Our software itself will actively manage it. It will trade for you. It will buy and it will sell both ways. It also builds the algorithms. They're already built. It executes the buys and sells based on algorithms by Kelly, one of the world's best hedge fund managers. And so what we're doing is we're changing the way the problem gets looked at. Now, let's talk about that $1 million. I like to talk about this, and I use this slide in almost every presentation I do because I do believe it's very, very important. You need to know two things. How much money do you have, and how much money can that money make? How long will it take you to get to that point? So when we talk about $1 million, how do we get there? How do we get there? Oh, wait a minute. Oh, Kelly just joined us, so I'm going to have him join us as well. Are you on, Kelly? I just unmuted him. Oh, he's muted still. Yeah, he's unmuted. Unmute yourself and turn off your camera. So he'll get himself unmuted and I'll get him on here. So when we talk about $1 million and the power of why a million, it's less about the million than what the million does. What the million does is it allows you, if you're participating in this 10, 15, 20% world, right, it allows you to guarantee revenue. $1 million at 15% per year will produce $150,000 of residual revenue. It will kick off 150 grand a year forever. This isn't 5,000 a month for 20 years on that million. This is 150 grand a year forever. And at the end, you get to keep your million. And when I say keep, I mean you get to give it to your children. You get to give it to your charity. You get to give it to your church, wherever you want to get it. Now, the next piece you're looking at is how do you get it? Well, $500 a month, just saving in that shoebox, it will take you 166 years to get it. Okay? $1,500 a month at 20% return, 13 years. I want you to chew on that for a second, folks. It may seem like a big difference in time, and that's because it is. It is a big difference in time. And so I do want to stop right here for 1 second before I jump onto the next slide. And I want to introduce Kelly. Kelly, we did have some, as you noticed, we had some technical difficulties this evening. But we still have a handful of folks on here that have joined us, and I promised all of them they'd get to meet you tonight. So, hey, Kelly, welcome to our call.
Well, thank you very much. I tried the Zoom link, and then it didn't work, and then all of a sudden, with persistence, it worked.
That's what happened to all of us. I started it, and people were texting me, "Hey, I'm on." I'm like, "Yeah, so am I." I don't know what to do. I got our team on, and they fixed it. So that was great. But hey, Kelly, can you just take a little minute here and share with the 10 folks we have on the call about, why flipping Wall Street? Why would you want to work with me? Why are we Silicon Valley meets New York City in this thing? And what really is the impact with our technology and the way we've gone to market that we can have on the world?
That's a loaded question. There's a lot of things inside of the answer to that, but I would say, look, fundamentally, I think the advantage of someone that joins our community and invests our way will take advantage of scaling without a scaling of their portfolio, without a scaling of their fees. Fundamentally, that way Wall Street makes money, where I spent 30 years, is that the fees scale along with the client's assets. And to most people, that's reasonable. But what we do and what makes us important and interesting and why our business can scale is we keep your fees flat. So whether you have $50,000 or $1 million, it makes no difference to us. We charge the same amount. We feel that it's our job to provide protection and also stimulate growth inside of a portfolio. And we feel that using the algorithms and the way we do it has a huge advantage, especially over the long run, as the fees of belonging with us and investing with our methods will become incrementally smaller and ultimately, essentially, go to zero as a client's portfolio grows. And if you top that off with the fact that we do feel that we can beat the market, and beating the market means, yes, we'd like to outperform the market in a good year, and especially avoid major corrections, which of course are littered inside of our history of the markets, then we know we can beat the market, especially over the long run. So it's not just year to year we hope to win, but it is especially during times of calamity or distrust of the markets or distrust or fear of the unknown, that we tend to do much, much better. This is the way the capital markets work. If you're inside of a bank or a large hedge fund, the flows of money are always to keep your money active when it's important to be active and keep your money on the sidelines when it's not. So I think Flipping Wall Street offers the best ability to both scale in the short run and also in the long run to keep your costs down, where every dollar you have is really going to you and not some manager.
Excellent. And I understood it.
Periodically, I can be clear.
Oh, you're always clear. You just sometimes over everybody's head. It's fantastic. Well, hey, thanks, Kelly, for doing that, and feel free to hang out with us for the rest of the webinar if you like, and chime in at any time you want to.
I'll keep listening.
All right. So that is, a little bit. Like I said, I wanted to make sure you guys all got to meet Kelly, and this is the $1 million chart and why we talk about it so much, and why those of you that have seen me at an event spend a lot of time talking about it. So now let's really look at one of those myths, and I like dispelling this myth, and I talk about it a lot. The myth that in order for you to maximize the markets, you must not be emotional and take your money out ever. You must leave it in and ride the ups and downs of the market in such a way that you trust the growth of the market over time will take you to the promised land. So let's look at that. And let's look at that as if it was spread out over the whole NASDAQ. And we're the guy in the shoebox. We're the opposite of that guy. We're putting all our money in and we're leaving it. And we're going to start with $100,000 back in 1987. And then something happened in 1987, and I know there's a couple of you on this call that are old enough to remember it. There was a big crash, the crash of 87, which allowed you to finish 87 with $73,000, even though you started with 100. But you ride it out all the way through to the year 2000. Your 73 grew to 421. And again, I know some of you were around in the early 2000s when that awesome dot bomb went off. Well, that would have allowed your 421 to grow into or shrink into 126. You're committed, you ride it out, you take it all the way to 2007, and by then, your 126 was up to 237. If you remember the big credit crash, America fell down, real estate, stock market, everything just went down, down, down. Well, by 2008, that 237 was down to 104, but you're still committed. You believe the myth, so you ride it out. And by 2017, your 104 was 318. How happy are you now? Probably pretty happy because you got $318,000. You're all excited. But the reality of that is that's a whopping 2.5% per year pre-tax portfolio. Well, if that works for you, then the buy and hold, don't touch it, leave it alone, might work for you. My question to you is this. What if you were able to just avoid those? If you were able to time the market, remember the slide at the very beginning with the, Back to the Future car? Yes, we can predict and time the market if you know the math. The algorithms that we have are designed to do just that. They avoid the big dips, which is what these three events were. And they allow you to approach it from a different way. Instead of being always in, wouldn't it be nice if you could be out of the market when it was dropping and in the market when it was rising? And if you could have avoided those three events in that same time frame, that $100,000 would have been 2.1 million. Chew on that number for a minute. 300,000 or 2.1 million. Big difference. Now, how does that happen? And I'm going to call back on you here in a minute, Kelly, if you're here.
I still am.
It happens because the algorithms, and here's a perfect example of it. The red line is buy and hold. You just kept your money in. This is the S&P 500. You kept your money in. There's your big 2002. There's your 2008. And the blue represents the software and the algorithm making the trading. You'll notice the big flat blue lines when the red line's consistently going down. You see it over here, you see it here, and you see it in little tiny spots all over the place. Now, hey, Kelly, will you take a minute and talk to us about the importance of those flat lines?
Yes. Fundamentally, when I spoke earlier, just briefly, I can tell you that the idea is during calamity or a chaos or when there's stress in the financial markets, as you see in the middle of the chart, you see the blue flat line that represents the financial crisis of 2008. And prior to that, you see on the left side, the blue line's flat. That's the NASDAQ bubble. If we were to go back in time, we go back to 1954, which becomes kind of meaningless. But there was many events before, after 1954, which also had similar events: the 1987 crash, the 1992 recession, the flatline no growth market of the 70s, the calamity of inflation calamity that occurred in the late 70s during the Carter administration and when Reagan came in, all produced times of financial stress to the markets. And that is why when you see that flat line, what's important is it's showing you that the position you take during that is cash. It's as simple as that. Cash is a position. People, we can go back there, people have the idea that if they're not invested, they can't make money in the market. But Wall Street and sophisticated investors realize that that's simply not the case. The case is you want to be invested when the market is moving in a direction you expect, and you want to be flat when the market is uncertain and you don't know where the market is going. So it's kind of, we use a rule called the 3-5 rule. The 3-5 rule is very simple, is that we really want to take always 3/5 of the move, and we want to avoid being in the market for the bottom 20% or the top 20%. In other words, what we're trying to do is take the meat out of a move. So for example, after the financial crisis, if you look towards the middle of the screen and if you can scroll down and see the numbers, somewhere around 2010, looks like around February or so of 2010, the blue line starts to be jagged. In other words, it's in the market, and you can start to see it move. You can see right below it, the red line, which is the S&P 500 spider at the time, is also moving along with it. You notice that the spider had actually rallied quite a bit off its lows prior to the algorithms saying, let's get back in the market. But during that time, since 2010, you can see that the blue line advanced pretty much equivalent to the S&P 500, and it now maintains a lead. Over time, this lead will grow larger and larger. Why? Because over time, there's more and more corrections. And the more corrections we have, the wider it'll become. So the reason why we want to, the flat lines are so important is because they show that the position of your portfolio is cash. And cash actually has a lot of meaning when everybody's afraid. If you're the person with cash, you have a lot of advantages. And that means that you have a kind of emotional and psychological security during those times as well. We cannot sell the high and we will not buy the low. But what we will do is we will be involved in the market when we need to be, and we will be flat or flat lines when we don't. And to put a little final piece on that, if anybody understands Fibonacci, not that this is a big thing, but you notice that 3-5 rule, both 3 and 5 are Fibonacci numbers. The sum of the two, of course, are another Fibonacci number, as they always would be. And there is an order to things that follows these kind of natural laws. And that's kind of the way Wall Street investors work. And this is the algorithm you see before you right here is just one running the S&P 500. If you simply just took this, you will be better off. You'll have a diversified portfolio, and you will be out of the market when it has calamity, and you will be in it when it's moving. And the flat line is a fundamental piece of the way we trade and invest money at Flipping Wall Street.
Thanks, man. And I want to ask you one more question. Can you explain the when we talk about diversification as in a mutual fund, not your friend, versus diversification through the way we do it? Or risk management, beating the market. Why do we not want 500 stocks?
There's a lot of reasons why we don't want 500 stocks. Mutual funds carry with them enormous amounts of fees. I'll start with the fee portion of this. The fee portion of a person that invests in mutual funds especially through an advisor, or generally a 401k or any kind of other form of pension, believe it or not, those fees can be as high as over 4%, 4.15. Why? Because those are the advisor fees, etc. When advisors sell you and put you into a mutual fund, they get paid by the mutual fund to put you in there. And the mutual fund charges a fee for you to be in there. So the idea of the being involved in a mutual fund is kind of ludicrous. What we do is we believe that a narrow portfolio is a wiser bet. In other words, you don't need to have this broad portfolio, even if you have millions of dollars, tens or 20s of millions of dollars. You don't need to be that broad. You need to have your portfolio invested in such a way that you keep your monies focused on a narrow group of stocks that will ultimately diversify you in a small way. But rather than diversification through a mutual fund in this wide ownership of stock or through funds, the idea is to use an algorithm to manage the risk rather than diversification. So let me put it another way. If we diversify by buying 100 different stocks, first of all, there's no way I can beat the market. However, if I diversify smaller, maybe only 10 stocks, but I use algorithms on those 10 stocks, not only do I have the chance of beating the market, but I also have the chance of doing much better than the market if the market corrects, because the algorithms protect the downside.
Yep. Perfect. That was the nugget I was hoping you were going to share with us. So thank you again, Kelly. Do appreciate you jumping on here. All right, folks, let's slide on and look at a real portfolio. This is a real one. This is up and running. It's been running for a while. And what I want to do is just kind of show you what a portfolio looks like. This is one with 10 stocks in it and is, by our definition, extremely diversified because it has 10 stocks. Most of our portfolios have 3 to 5. Now, you also notice that each stock is attached to a strategy. Home Depot Max, Apple Mesa, Netflix First Profit. These guys are down here all internal wide. One of the things that our software does that is unique to our software is that it takes each individual stock and applies a strategy to it. So this stock is trading in the first profit strategy, which is just the naming convention of the algorithm, independently of all the rest of these. It doesn't matter what's going on in the rest of your portfolio. Each stock functions independently. And even within each algorithm and each day, they're operating independently. Now, this portfolio is a normal average one. This isn't some kind of I picked the best one possible. If I pick the best one possible, Kelly gets mad at me when I do things like that. He wants average. Show what the middle looks like. This is normal. And this normal for this portfolio has done 36% a year. Now think back to the slide about $1 million. At 20%, $1,500 a month gets you to $1 million in 13 years. If you have some money to start with and you can average returns like this, and we can't guarantee anything, it's not legal. If we are able to produce above 20, what does your life look like over time, and how fast could it possibly happen? And just so we're clear, we're not talking about, Bitcoin from 3 years ago money, or even yesterday. We're not talking about 1,000% a day or a month. We're talking about real returns in a real safe market. That's the idea. So that's just an example of it. Now, what comes with it? We are a community. When you join our community, that's exactly what we are. We're a community that is designed to help you, work with you, teach you, and set you up to be successful in your investment. When you purchase our software, you get the software and a lifetime of free upgrades. That means from now on, whenever we change, add new algorithms, add more stocks, add more stuff, do more things, you don't ever have to pay for it. You get a newsletter every week to 10 days from Kelly that he writes about what's going on in the market. You get access to our training platform. Kelly will actually teach you how to do the algorithms if you want to know the math. I haven't learned yet, so some people like that though, and if that's what you want to do. And you get access to live training events that will be coming soon to a city near you. So if that's interesting to you, we also have an affiliate program. We are only an affiliate program. So when you make referrals, a chunk of the money that you referred to us when they buy goes to you. And that's a big deal. As a matter of fact, if you refer 5 people to our platform, your software becomes free. In essence, and maybe even a little profitable. Now, that was interesting. So now what? Well, it's real simple. What each and every one of you need to do or want to do is get a live demonstration. And how do you get a live demonstration? There's only one way to get it. You email me. And when you email me, you're also going to get access to some specific deals and discounts and things that we have going on that's specifically for this group. So I want you to shoot me an email, and then I will send you back an email that's got a link to my calendar on it so that I know who you are and I know where you came from. In that calendar invite, you just pick the date and time you want. You schedule an hour. I will give you a demo. I will walk you through it. I will show you how to use it. You will be set up and ready to go if you decide to move forward with us at the end of that hour. And that is my request for each and every one of you. And again, I will apologize one last time for the technical difficulties in the beginning. I appreciate each and every one of you being here. And I'm going to do this webinar again tomorrow night for everybody else that didn't get to make it on because of our technical difficulties. So you'll get another invite to attend this webinar tomorrow as well, just so you know, because you're all part of the list that registered. So everybody that registered for tonight will get invited to a special webinar tomorrow night. That's it, folks. Thanks for joining us. Super appreciate you taking the time to be here. Hope all of you have an awesome evening. Talk to you all soon. Thanks, Kelly.
Thanks, man. Bye.
And good night.